This is your host, Stephen Sargeant, Around the Coin podcast. We have Annelise Osborne. She's the Chief Business Officer at Kadena. She's also the author of a book called From Hoodies to Suits, innovating digital assets for traditional finance. We talk about her early days working in commercial mortgage-backed securities, and she breaks down about exactly what happened in the 2008, 2009 chaos with mortgage-backed securities. We talked about all the applications, Bitcoin, blockchain, and cryptocurrency when it comes to traditional finance. And she goes into details as to what they're working on at Kadena and what they're helping companies with. But more importantly, we talk about the insights from her book. This is a great episode for anyone that's especially listening to this in traditional finance. You might want to sit down and capture this in full and hear some of those insights and maybe even pick up her book. We'll talk soon. This is your host, Stephen Sargeant, the Around the Coin podcast. We're with Annelise Osborne, the CBO at Kadena, and, a pretty critically acclaimed author, I might say. You got Toronto in the frenzy when you came down with your book. They were all acquainted before the actual book signing, if I remember correctly, which is always a good sign. Maybe not so much logistically as an author when you don't have books to sign, but, people have shirts, people have arms, you can definitely gives those signatures there. Why don't you tell us a little bit about you and your background?
Well, Stephen, thank you so much for having me on. I've been listening to your podcast, and I look forward to having my book up there on your back shelf. I'm sending you one after this because you probably didn't get one in Toronto. So I worked in traditional finance for a number of years. I worked majority of my career at Moody's doing commercial mortgage-backed securities, and then I left because I was kind of looking for more entrepreneurial work. Like Moody's was fantastic, super great think tank oriented work. We created new structures, changed the price of borrowing, which is what structured finance really did. And then I got into through a lot of board work. I ended up getting into crypto through board work. I was asked to join this regulatory task force for ICOs. I had no idea. Well, that's not true. I wasn't very familiar with ICOs. I'd heard of them. I had an idea. And it was young, energetic lawyers that had put together this task force. And the thought process of there's huge benefit with cryptos. There just needs to be some sort of regulation. I watched loads of podcasts. I actually it wasn't podcasts at the time. It was just on YouTube, though. This was back in 2017, 18. And that's really where I learned a lot. And then the more you learn about blockchain, the more you're like, this is perfect for finance, which is kind of where my experience was from a traditional perspective, right? We could talk about kind of how the idea of Bitcoin, like in 2008, how that came up when it was the world of Occupy Wall Street. But yeah, so that's how it kind of launched my bug. I assumed other people were doing it. It wasn't for me. But then the people that were actually trying to do traditional finance on chain for security tokens at the time, now I kind of call them digital assets, really were entrepreneurs or tech people. And they had this great insight, but they didn't have the experience understanding structures of finance or regulation. And so that is how I met a partner. We launched in the space, and that's how I got to be here in 2018.
That's awesome. You're not even able to skim past mortgage-backed securities, even though you're on the commercial side. I think everyone on this podcast knew nothing about mortgage-backed securities until, the global chaos and collapse in the financial ecosystem back in 2008, 2009. Talk about being in that field, because you were in that field, in that space at the time. What was that like? Did you have any kind of idea what was happening on the residential side? Did it make perfect sense to you? Like, of course that would happen if nobody's really paying attention. Bring us back to that time, because all eyes were on you and your sector at that time.
I feel like we could have a podcast on this, but I love it because I'm never asked about like MBS. So at the time, I mean, you've residential and commercial, right? If you think about commercial mortgages are loans that are on offices, which have 10-year leases, which are investments. You have them on hotels, which price every night, which makes it more risky. Industrial properties, shopping malls, which shopping malls were good at one point and then bad at one point because there were too many of them, right? Industrial properties and multifamily. But they're all investments. So they're all generally leases in place for periods of time, and they're investment oriented such they have a cash flow coming in. Residential is a little different. Residential are if I'm going to pay my mortgage or not, right? It's I decide if I'm going to pay, as opposed to having a company and leases in place where there's actually revenue and cash flow. So I feel like that's kind of a fundamental difference between commercial mortgage-backed and residential mortgage-backed. Also, if you go at the time, so there was I assume everybody listening kind of understands, in 2008, there was a huge crisis that really was based off residential mortgage-backed securities. And there was a lot of fraud associated with that because there was a big push, and admittedly, there was a government push for people to own their own houses, and there was an encouragement for lending. So new lending products developed, and with the new lending products, there was some that had no income verification. So it was easier to actually buy a house because you didn't have to prove that you made money. You just had to figure out how much can I put down. And lots of people were out there giving loans, so it created competition. So you'd have someone say, okay, I'll give you 95% loan to value, right? So I only have to put down a little bit. I can buy this house. It also increased the price of housing because there's more competition out there and I can put down less money. So
did that also make it less risky? Because hey, the house prices are rising, and you only had to put down a small amount, and look how much my house value went up in such a short span.
Well, also,
did that give a perception of like, there's no way I can lose here?
Yes. And the way that it was looked at was all historical. Historically, there hadn't been many losses.
Right.
So if you're looking at what's the risk and you're looking at, well, if we look over the last 20 years, right, there's been very few losses, but it hadn't gone to a period where there'd been so much aggressive lending, right? And there had been fraud associated with it, which you kind of understand when you'd hear people who didn't have full-time jobs that were owning multiple properties because they kind of got these loans. There was also adjustable rate mortgages where people didn't really read the documents to understand that I only owe this much today, but that's because it's interest only and it's going to, or a low interest rate, it's going to readjust. So there was a big kind of fallout there. From the commercial perspective, there was problems, but not the same because you had that income coming in. The bonds were worth very little at the time, which was a great time to buy them if you believed in the fundamentals. If you think about commercial cycles, I was rating them, so like, how do you understand the risk? And the risk generally is either that it will default during the term, which means that the money that's coming in can cover that, and or if it defaults at balloon, because usually they're 10 years and they still owe money at balloon, will they be able to cover that? So that's a value perspective versus a cash flow for perspective. It was interesting to try to figure out, okay, property values have dropped, but the only properties that are changing hands are ones that are in default already. So it's not the ones that have leases in place, right, and are cash flowing. So you have to kind of differentiate. You can't really look at current property sales in that situation. You have to understand that the property market is cyclical, and at the time of this being paid back, you're going to have been through this period of time. That said, there were a lot of different types of structures that were tied to specific properties. There was a large company that went under because they had corporate debt that all came due. They had gotten short-term corporate debt for cheap, and it all came due in a world where you couldn't refinance it. So the properties weren't bad, but the company went up. So there were a lot of different things that were happening, just different tides and flowing.
Right.
And it was super interesting. There was a lot of negative sentiment. Absolutely. I remember being attacked at a cocktail party once. And then some people lost money, but
Right.
it was interesting.
And their house, right? They lost money in their house and a lot of other things probably.
Well, the people that lost money at the house were not at this cocktail party in New York, but there was a lot of people turned in keys. It was an interesting time. I'm more than happy to kind of go into it and dive into it further if you want to go, but I don't know if
I was just wondering, would the pandemic have been the equivalent at that time for the residential mortgage? Like when the pandemic, you were talking about value and payments. When the pandemic happened, it was that nobody's going to the office and companies are folding. Would that be a similar time where the commercial mortgage-backed security market would kind of hit the same way the residential one was?
The market was huge way back when, right? It didn't go like in 2007. The deals that were being done were huge, like $10 billion. The deals that are being done now are less than $1 billion, and so it's definitely more metered, right? It's more ideally de-risked to an extent. So, but if you look at kind of what happened in the recent with the pandemic. Offices were hit. Before, offices were kind of fantastic because if you had a good location and you had a good tenant roll, that they continue to pay. And now all of a sudden, you can have a good location, but maybe you don't have as many tenants or they need less space and people aren't showing up for work or offices. I feel like New York, which is a huge office market, had fewer people going into the office than, say, Dallas did, or markets in Florida. So there's definitely stress on the office market, yes. Because you also have suburban offices, you have downtown offices.
I love it. Thanks so much for educating. 'Cause I think those are the interesting things. To your point, I don't think anyone talks about them. And it's just great. I think the message we want to show, as I said before the show, is like we want to be conversationally dangerous in the sense that we want to know a lot about random topics because they do come up in conversation. And I think who better to learn from than someone that would like in the middle of the market. And I haven't met very many people that were even close to that market. But then you transition into crypto.
Can I
What
say
is some
Sorry
Yeah,
to
of
interrupt.
course.
I have one thing to say about mortgage-backed securities so people know what they are. The idea of mortgage-backed securities, before a bank would write a loan, and a bank would write, say, $100 million loan, right, to this office property. But if that loan defaulted, that's huge risk on the bank's balance sheet. So what the banks did is they pooled all these loans together that would make up, say, $1 billion of loans. And then they would sell them as bonds to insurance companies or different types of people that looked for that risk return profile. Because you can cut up the bonds that the senior bonds were less likely to default because the losses would have to go all the way up the capital structure. And then there's high yield bonds at the bottom that would take the first loss. So the idea of mortgage-backed securities, to not give them a bad name really, was that they shifted the risk from banks' balance sheets. So instead, it decreased the cost of financing because it was less risk. So people could get more competitive interest rates. So I just wanted to share that that's kind of the basic idea of why mortgage-backed securities started.
Yeah, and I don't know if there'll be ever a commercial version of The Big Short, but it'd be interesting to see.
We were in there, yeah.
uh, when you come from, as you said, traditional finance into blockchain, what was one of the first things you're like, oh, blockchain can solve this? I can't wait. Like, there's always that moment where you're like, oh, I've been having this problem in traditional finance. I can't wait for something to come along, and you get into blockchain, and then I really want to jump into the ICO working group.
Sure. So for me, it was loans and debt. If you think about, because I'd been working in that industry and servicing, so there are problems. We did have problems where deals were paid down incorrectly, right? So because there's a lot of human error there. But if you think about what a structured finance transaction is, or even a loan, that can all be programmed. It's all math. It pays out when it's supposed to pay out. You can use conditional. You can program money now. There's all these amazing things that you just understand smart contracts can do that make it not only kind of more efficient, lower cost, but fewer errors. And so for me, the idea of doing fixed income and doing servicing even, which could be fully automated, I recognize technology as a tool and that people are still needed, but that kind of was my big wow, like this would be fantastic.
Do you think it's beneficial when you think of smart contract? Do you think it's beneficial that you're actually removing the human emotion out of it, right? Because think about it, if you're, let's just say, take a common landlord tenant, they don't pay on time, the door locks because of the smart contract code. But in real life, the tenant might be going through something and they need help or they need that extra. Do you like that? Smart contracts for the most part aren't rigid. Are rigid actually and aren't flexible or lenient, and they kind of it's easy to keep track of them because they are programmable versus, or do you like the idea that, hey, if a loan officer is somehow feeling that they should help out somebody because they're going through a tough time or saw that they just lost their job, that there is still that flexibility in real life?
So I don't think everything is black and white. That's kind of like what we're talking about, right? And so I do feel like there's still a gray. If you think about, we'll go back to mortgage-backed securities, it's in a bond, which is in a trust, and there's not a person to talk to when it's in the trust, but there is, because if you have problems, it moves to special servicing and someone helps you out, right? So I do think, and I see technology as a tool. And so if you're doing a loan to someone, there are loans that are tokenized now. Figure's doing a lot of home equity loans and lines of credit. I would guess, I do not have one of these loans, but I would guess that you're going to be able to talk to someone in periods of default, because honestly, it makes more sense for the lender. History shows that the lender will make more money if they negotiate, like they find out something together with the borrower, because they really just want the money back, right? So I do feel that, yes, there's a lot of efficiencies smart contracts bring, and I do think there's also the human element that can still be involved even using this technology.
I love that. So you're working with Kadena as a chief business officer. The website says, that you believe that Kadena is the only blockchain capable of powering global finance. Then some big fighting words, especially for a lot of our guests that are building layer 2 protocols, etc. Why do you believe that Kadena is the spot that can, really power the future of global finance?
Stepping back a little bit, Kadena was founded by two JP Morgan gentlemen, and they had created JP Morgan's first innovation lab. And they worked on the first blockchain. They had worked on an early JP Morgan coin. And then they left to create kind of the best of both worlds with Bitcoin and Ethereum. So Bitcoin being proof of work, Ethereum being programmable, scalable, low gas cost. But the way they created it is a web of chains. And so the thought process of scaling, so it's not all on one chain, it's a web of chains that are tied together with nodes. So you can continue, so the thought process, you continue to add on chains, and that's the scalable. So it's horizontally scalable. And that's the idea of being able to not kind of slow down or hurt the network. Proof of work, which I think a lot have moved again away from proof of work, has really proved to be very secure. We had a hack a couple weeks ago and the system didn't go down, right? So we had, because of the way that it's structured as proof of work. So I think that is hugely beneficial. And the way that we're structured as nodes is that we don't have the energy consumption of Bitcoin. It's kind of shared through all of the different chains. So that's, ideally, I believe in that. It's great tech. Great tech doesn't always win because there's a lot more that goes into it than just tech. Obviously, huge is there's so many different things that go into that. One is, working with your developers, making sure that you have an easy developer experience, finding people to build on chain, finding out kind of really your use cases. But that's the idea of being kind of globally scalable.
And is there a reason why you started to create your own blockchain based on the Bitcoin model versus now we're seeing a lot of companies build on top of Bitcoin with DeFi? What is your thought process? How do you choose how to build, where to build, Ethereum versus Bitcoin? Obviously the security is there, but Bitcoin, as many will say, the scalability issues are also there.
So Bitcoin's not programmable, right? Bitcoin, and I feel like Bitcoin is amazing and outstanding. So we talked about kind of the crisis in 2008, and Bitcoin actually came out in 2008 as a peer-to-peer payment system. So it was a whole bunch of people against banks, right? It came out at the time, there were a whole bunch of people against banks, but it was kind of how we can pay each other. So I feel like it was absolutely amazing and outstanding in what it created, offered kind of to the world. And then kind of moving on from there, there's other iterations and things that can be created like Ethereum, like smart contracts, like programmability. So I do feel that, yes, Bitcoin is obviously amazing for what it is. We're looking at building, Kadena went live 5 years ago. And so it's been around. It's just been a little bit of it's been a little bit sleepy in the sense that it didn't have the business sense behind it, which is why I came along 4 months ago to say, okay, let's build and strategize and grow. Because it was brilliant tech guys doing tech. Right. And they were creating, it was kind of like, they kind of saw themselves as an innovation lab. And so, and also going back to the JP Morgan roots, Will had worked at the SEC prior to JP Morgan. Stuart had worked in a number of trading shops and even Apple before, but they created the chain for financial settlement. Now, we're working on kind of building and growing the chain. So we don't have, we haven't worked with the big players yet. We do have a number of projects we're working on now, kind of figuring out the best way. So I also think about, from a business perspective, there's a lot of great chains out there. There's also there's a world of business out there too. So I don't think it's one winner. I think there's a lot of, there's little differences with the different chains, but I also feel like there's enough business for everyone. So I think that we are talking with people kind of for data projects. We are talking for financial. We've got debt, which I'm excited about, especially obviously tokenized funds, I think, have shown off, and stablecoin, right? So I feel like the big use cases to take off in general for this technology for the first adoption phases will be stablecoins, right? Digital programmable money, because there's so many use cases around the world. I would like to see kind of more being done in debt. Less in the US is happening than there is in Europe, which I think is the regulatory grayness, where you can't be gray, you've got to be black or white for institutions to play in the space. And then the last is really the tokenization of different funds and private markets and opportunities that give more people access to investments, which is really what the ICO was.
And where does Kadena play in it? So let's just say stablecoins. Are you kind of building an infrastructure similar to maybe BVNK? Like, are you building something for the companies that are like, hey, we want to use stablecoins to kind of power our international settlements? Like, where do you guys play in the ecosystem when you bring up a use case like stablecoins?
Sure. We are early in our world of growth. I will put that out there. So we have looked at a number of different options. Stablecoins are important in different ways. So one, there are other kind of private chains or chains that have worked with institutions out there that don't have kind of the liquid token as much. So we do have a liquid token, and DeFi stablecoin is super important as well. And then from a cross-border payments perspective, like I think what JP Morgan has done is amazing, and I expect more banks will come out and do that because they save so much money having an internal stablecoin depository receipts. I don't think banks should create their own stablecoins because then that really goes back to the world of banknotes before we had a federal currency. And I don't think that makes sense. I do think there should be more, and I think there probably will be more competition too. If you look at kind of Tether doesn't really work in the institutional world. There are huge use cases, obviously, for it. USDC, I think, will probably have a competitor, right? So it's not just those, but I don't think it will be. I don't think it'll be algorithmic. I love DAI. We could talk about DAI and some of the first deals that we did at my first startup. But I think it will be I do think there'll be some competition. I know people who are kind of starting up institutional based stable coins just to work with banks and payments. But look at, you've got Swift, you've got all sorts of people that are looking at stablecoins from regulators are looking at stablecoins. You have a lot of government bodies as well that are or people that are connecting securities or payments, right? FedNow is coming out, which is different because that's not programmable and it's centralized.
Right.
So I still think there's huge use for kind of decentralized money. So I've gone off on a little bit of a tangent, but we are looking at creating our
covering the use cases that you are focused on, Kadena, is important. What are your thoughts? Because we move from ICOs. You mentioned I remember security token offerings was a huge hit for 6 months. Now we've gone into more digital asset or real world asset tokenization. Different words, very similar. What we're trying to take physical or financial products and put them on chain. What have you learned from the ICO working group to what you're seeing now in real world asset tokenization?
Sure. So going back, the ICO, the task force, the gentleman that started it had written a paper that had gone viral. Well, coming in finance, you don't want anything to go viral because you don't really want your name out there unless you're the CEO of a public company, because then you've done something wrong, right? So you really want to keep your head down low. So it was super interesting to me, that aspect, to recognize there's a huge world out there, and there's this demand for investing in early stage tech projects because they missed the tech boom. So these are retail investors that wanted to come in and have the opportunity to partake in essence, venture capital. And so that was super interesting to me from an eye opener from the investment side. And then kind of from the company side, if you think about it, it's so an IPO, you have an advanced company that launches to be public. An ICO, you and me have an idea and let's get together and launch something. So strangely, not everyone that launched things actually were able to create that idea or create it into a business. I do think there was fraud, but I also think there was people were not inexperienced in business and didn't know how to do it, right? And so I think
similar to what we saw with NFTs, right? They said they were going to make comic books and video games, but if you've never done either of those things, you really don't realize how hard it is.
So this is why I think kind of hoodies and suits. We need the experience, and we need the innovation and the ideas, right? And that tech prowess. So I do think kind of from the ICO perspective, for me, it was an eye opener about how global the world is out there in investments. And if you look now at where the wealth sits, it's globally, it's 51% retail and it's 49% corporate. So now the retail money is more than the corporate money. And so I think there will be more opportunities for that retail sector. People are trying to go after that retail sector. And how do they do it? They do it with this technology because they make it more efficient and it's easier. It's easier to add more people into the process, right, on board. And it's also easier to track. You can have lower minimum buy-ins. So I do think that this technology, which is kind of the investments and the funds opportunity and the world of private markets, right, that people, if you look historically, alternative assets have really only been invested in by the ultra high net worth within the retail sector. And if you look at, sorry, I'm going off on another tangent, but BlackRock shared the ultra high net or family office investment strategy, right? How family offices are investing. So we grew up learning in finance, it was 60-40 stocks and bonds, right? Now BlackRock's 60-40 alternative and traditional, right? So 60% is your traditional stocks and bonds and 40% is your alternative. So that is how you generate wealth. It's not just the stock market. And so I feel like to do that, it's hard to do that using the systems today without this technology. Does that make
I
sense?
love that comparison. And this is a podcast. This is what you have to do. You have to go down tangents and rabbit holes and ramble. And this is how I love to do. I'm like, oh, how did we get here? And it makes people like, let me go research that, report. And that's what I love about it. But you did mention From Hoodies to Suits, which is your new book. Talk to me about that concept. Like, I think like how you came up with that. I think I know how you came up with it. I would have came up with it because like that's what it feels like the conferences have turned into. I've been in this, I'm going to conferences since 2016. And it's like, yeah, hoodies and, branded t-shirts of your company. So now I'm bored. I'm like, oh, people are like serious. People are coming with their briefcases and they mean business now. Tell me about the concepts of what is the hoodie and what is the suit and how you came up with it.
Sure. So when I first got into the space in 2018, I met my partner who had a similar idea as I did about tokenizing, like the idea of tokenizing debt. Right. And so he had a broker dealer already, and we kind of launched tokenized digital assets, were security tokens at the time, where we were trying to create traditional structures tokenized. We were then we started to merge with AirSwap, who had done a very successful ICO, parent company, Fluidity. And I'm bringing this up because we were the suits, and they were the hoodies. And we actually kind of moved into their office space as we were merging. It was just so interesting because I feel like you need both sides to make this happen make this technology happen for capital markets and really upgrading finance. So that was a basic that I had learned earlier on. So kind of fast forward, I worked at Arca Labs. We had a tokenized treasury fund, which was interesting in itself. And we worked also with institutions working on kind of partnerships. How do we develop programs in digital assets and different opportunities together? And one of the banks had said to me, we have a cease and desist after the FTX collapse, which was also after the Luna collapse, right? But they had said, we have a cease and desist, which is a legal term, but it wasn't really a cease and desist. But we have a cease and desist talking about digital, like anything crypto or blockchain until next year. And to me, that didn't make sense because what happened with the FTX was not a technology problem. It was a bad actor problem. And bad actors are in traditional finance as well, right? You had the Bernie Madoffs, which is a very similar idea to what happened here. Even Luna, you had long-term capital management, which was in 2018, which was an algorithmic by Nobel laureates trading shop that went under. So, anyway, it's not specific to this technology. And so that to me made me think, wow, I think there's 3 holdups for institutional adoption. I think the first is education, understanding what this technology is and how it can make sense to you or me. And then the other is regulation. Like in the US, we need to have black or white. We can't have this gray area. An institution can't play in the gray. And then the last, I think, is interoperability, which is both from how do we plug into institutions, but then also how do the blockchains talk to each other? And so I thought I could I could make a difference with education. Like that was what I should do. And so over the holidays, I sat down and I thought about like every day I start with a table of contents over the holidays. And I was like, okay, I'm going to do this book. But for me, the hoodies have created this amazing, 2.5, granted it moves around, $1 trillion economy and world. And they've gotten it kind of where it is today. And there's so much further we can take this. But I think the idea of the hoodie being the kind of the tech and the entrepreneur, we need the suits that come in, which are the ones that have a little more experience, understanding of regulation, to come in and meet in the middle and kind of work together. And so that was the thought process of the hoodies and suits, because I think they're both very important in making this happen. And I don't think they either can do it without the other. And so I tried to write a book.
Do you think hoodies approached it a little bit, not wrong, but they approached the industry? Because remember, they came in saying, we are going to disrupt traditional finance. We don't need intermediaries. And then they kind of realized like, hey, in order for us to operate our business, we kind of need bank accounts. And those are kind of the people that we told we were coming to disrupt. Do you think that's where they could have probably used some good suits at their boardroom table to kind of say, hey, this is great. This is not so much destruction, but this is acceleration. Like this, even the wording that they use and their approach to banking institutions. Do you think that kind of put them back a couple of steps so we could have been a lot further if the approach was different?
I don't know if that's the case, if the suits came in too early. If the suits came in too early and you had an over-regulatory idea of like, don't do anything, because that's,
Right.
if you ask a risk or compliance person, their first answer is always no, right? And so I do feel like that there needs to be a recognition of all this that can happen and look what we created. And now, granted, it could be in another country and not in the United States because you're finding different jurisdictions that it might work in. But I do hear what you're saying. Yes, you kind of need, if you want to really grow, you really need to have a bank account because there are traditional rails that you need to work with. But there's the whole DeFi world that has developed as well. And so that has developed, granted, there's been some people that got into trouble at some of the bigger companies that were successful. But I think that kind of wouldn't necessarily have developed as much if you had too many hoodies in place saying, don't do this. And so I think the companies going forward really need to have both. And I think you need to have both at that table deciding which direction and what to do, because there are companies here that we've seen that are run by suits. And I feel like, and they're kind of suits and they've hired some tech people, right? I don't think that works either. I don't think because it's kind of like an institution. How does an institution innovate? It's very difficult, right? I think it makes more sense to have innovation outside the institution that then you can bring in or buy, because of just the checks that you have to go through along the way. And I mean, it takes 6 to 18 months to bring an outside vendor into an institution. And so that, the way that technology is growing and moving, that moves too quickly. But I do recognize the needs for suits, but maybe it's fine that they didn't come in so early. So I think there's a lot we can learn from what crypto created and little, mishaps along the way that we can take into kind of growing the industry.
What do you say when, your traditional friends, right? You're at a cocktail party, and if they're coming at you about mortgage-backed securities, I'm pretty sure they're coming at you about FTX. And to your point, right? Whether they've lost money or not, it tanked the whole crypto industry. So what are your thoughts? The traditional folks are like, hey, look at FTX, Celsius, 380. That's why we're not talking about it. That's why we're not bothering it. What's kind of your counterpoint to that, especially when you yourself are baked within the technology there at Kadena?
If you look at FTX, right, everybody loved Sam Bankman-Fried. Like, he was very outgoing, gregarious, very smart. But he also didn't have checks and balances within the company, right? And he was also young. So even though he had worked at a hedge fund, I feel like he was still a hoodie, which was also part of his identity, I think. And so if there were more suits involved, I think that wouldn't have happened. He was given an outrageous amount of money. And I think part of that was he was making money, right? They were doing well. And other institutions don't want to be left behind. And so I feel like, and they're the ones giving the bigger checks. But there wasn't a board of directors. There wasn't risk and compliance. And there was no real kind of reporting that could be checked to make sense. So from my perspective, this is why it is important to have both come through. And look at Bernie Madoff. Bernie Madoff was, what was he? He was like part of the SEC, like compliance. He was really big into like being seen in the industry. Right. And so I feel like there's a lot of similarities with the two. And obviously, I would need to know more about Bernie Madoff and the setup, but did he have someone checking? Were there outside auditors? I think that's why finance is the way it is for checks and balances. So that's my thought process on kind of Sam Bankman-Fried. It's not so another reason I wrote the book, there were no books out there on capital markets. There were books out there on crypto, on DeFi, on digital dollar. And a lot of the books are textbooks and harder to read. But I think that the whole goal of it is to be educational and easy to read. But you also walk away with understanding, okay, I get the basics. And I think that's what we need from an education perspective, is like, oh, this makes sense. And there's a lot of things in crypto and TradFi that are very similar, right?
Right.
Wallet is similar to an account. Like, if you mentally, just to think about it, right? The idea of kind of keys and passwords, and it's just a little bit of a different lingo that if people, and yes, there are, there's minutiae differences, right? But the idea is generally the same. DeFi really is, I think, the private credit markets and kind of DeFi. I think that's one of the first merging. And I think DeFi will merge into TradFi.
Interesting. You talk about that merger, but we see like Bitcoin spot ETFs is like, we're heavily into suit territory with that, right? Do you feel like there should be other entry, a little more decentralized entry points for people getting the crypto? Are we going too much suits? And we're kind of forgetting that we need a little bit of the hoodies to kind of figure out fun ways. Like, I think, but 2021 was like, more people got into the market because NFTs were fun to get into. They were easy, but it also forced people to get into Web3 and use MetaMask wallets, and they weren't used to that. But it was helpful for getting people that would normally not be in Web3 into Web3. Do You think spot ETFs are kind of, taking us back to more of the traditional route for
So,
access to crypto?
yeah, two things. One from the not recognizing it's Web3. I think a lot of companies and I think a lot of opportunities will be that way. It'll be almost a Web2 experience for Web3. If you think about PayPal and PayPal USD, the having a digital currency where you trade immediately, right? Like I don't have to wait 5 days for a check to settle, and I'll have that money that I can put to work today. Like, but if in that format, you don't really recognize that there's a wallet or that you're using, decentralized token, right? So I do think there'll be opportunities that way that will just make the world more efficient, and no one will talk about the technology underlying it, because most people don't talk about like how is the World Wide Web set up, or how do my emails transfer, right? It's this technology has kind of, because of probably the cryptocurrency and the Bitcoin idea, and people are afraid of change that they see. I think that has gotten regulators concerned. There's no other technology that the banks are required to report that they're touching, right? If you think
Right.
about cell phones or faxes or AI or even quantum, right? They don't have to tell that regulators, look, we're going to touch this, where they do with blockchain. Okay, and then back to kind of the ETFs and the idea. If you think about, people want access to alternative assets and investments. And what I think the ETF is a totally traditional structure, but you're putting an alternative investment in there that now the world is recognizing that cryptocurrency is an alternative investment, and we want to have a diversified portfolio. And ideally, we want it not to track the markets, because it didn't used to track the markets, but now it is more likely to track the markets. But that's the idea of, if we can invest and we want some exposure. So I feel like it's a very traditional structure that is recognizing crypto as an alternative asset. But I will say, people investing, there aren't as many investors as we would think yet, but we will. If you think about that, and think about that BlackRock 60/40 alternative assets, traditional assets, and you think about the trillions of dollars that are in 401ks and retirement accounts, and if they're going to have a small fraction exposure to the alternative assets of cryptocurrency, they're buy and holders, right?
Right.
And so that's going to hold up more Bitcoin. And if you think about, there's less Bitcoin trading, then there's more of a demand for Bitcoin. It is likely that is helping solidify valuations for Bitcoin, where you think if there's fewer bits trading and more demand, it would go up. Just basic supply and demand, right? If all the Bitcoin ETFs are long-term holders.
Can I ask you one thing? When you write a book like this, and the technology and the headlines are changing every day, and you're looking for case studies and use cases, what's one thing you're like, man, it just missed the cutoff to the publishers, and I wish I could still sneak it into a bonus chapter, a blog series? What's one thing that you're like, oh, I wish I knew that before I finished writing the book?
BlackRock's Biddle, right? That came out after. So when you write a book, it takes, mine was only 6 months from when they finally edited it, or not 7 months when they finally edited it, to actually come out. Because I used a mainstream publisher who's been great, Wiley, and that was apparently fast, but for me it was slow. But during that time, I think the last time anything could go in was kind of January. So the Bitcoin ETFs were just about to happen. ETH wasn't there yet, but it was kind of along the idea of it's going to. And but the idea of BlackRock, which is the world's largest asset manager, stepping up and doing a tokenized treasury fund, is huge, because a lot of I don't believe BlackRock, and I could be wrong, I don't believe BlackRock was looking to be an innovator. I think they were looking to make sure enough people had done it, right? You have Franklin Templeton, you have Apollo, KKR, you've got Hamilton Lane, all these people have tokenized funds, and Wisdom Tree, right? And now BlackRock is stepping in to do this. And so that is huge, because they are so big, and they other people will follow suit. So to me, that was like a huge step in the market. But look at JP Morgan's the world's largest bank by assets under management, not assets under management, by market cap. And the next largest bank worldwide beneath them is half the size, American Bank. And then the next one beneath that is a Chinese bank. But it just shows you how much larger JP Morgan is than these other players.
Right.
And look what they have created. And that's going to help propel them, I think, right? That's what you need to stay on top of trends, so you're not falling behind, and you're not like Blockbuster or Kodak, who really lost, their opportunities, or AOL. And look at Google, and look at AOL.
Kodak's a great example. Like, you would think, like, it's funny because they talked about, how Japanese were, when you looked at the richest men, and there was a point where mostly of them were from Japan, with exactly that, right? Kodak and all the innovation coming out of that place, and it changes every so often, right? We're seeing Elon Musk now and Jeff Bezos, but it changes all the time.
I'm with you. I stay abreast of what's going on, right? And don't fall behind. So you've got to try out, even if it's uncomfortable. They did a study. I actually have a chapter on change. They did a study, and monkeys are better at change than humans. That's funny. But if you look at like all this technology, we're continually upgrading. This right here, our kids grow up with a supercomputer in their hand, right? And that has more power than when we went to the moon. And so I feel like, we're going to continue, and it's going to progress at a higher rate because AI also helps write code faster. We need people to check, but it's going to help increase innovation, and we need to be more comfortable with change as Gen Z and millennials are much more comfortable with change than kind of this older generation.
Right.
And Gen Z and millennials are going to have all the money soon. And they're going to be running companies. So I feel like you don't want to be left behind, and you don't want to not recognize that.
And that was included that, kind of this concept that although exactly what you're saying is right, you don't feel that traditional finance is going anywhere. I think that's true for North America. I'm in Canada, you're in the US. But what about places like Nigeria, El Salvador, where, as you say, younger populations, they're moving further and further away from the traditional fiat currency, which is unstable. Is there, a possibility in 20 years you don't see people using, traditional finance as much, or like almost like now if I see somebody pull out cash, I'm like, oh my God, like who carries cash anymore to pay for a coffee? That's unheard of. They have a wrist, they have a watch, they have a tap. What are your thoughts about that? I don't see my kids ever going into a bank to do a transaction like when my parents went in and we used to get balloons, with their checks.
Yep. No, I totally agree. And the world, especially with the coming generations, now there's developed markets and less developed markets. So we can talk about that. But your kids in banks, like I don't think I've opened bank accounts online. It is so much easier in the fact when I have to go into a bank for something. I'm trying to think of I had to go into a bank for something at one point. I think it was signatures for something, like changing names on an account. But it's so much more efficient, and people are used to doing this on apps, right? More and more generations are getting used to that. And I do feel the older generation, I do have we went to Alaska, and I always think of gaming as being like my kids. I have 3 teenage boys, right? I feel like they love gaming. In Alaska, it was generally, we'll call them retirees. We went for my mom's birthday, and my mom plays games on her iPad all the time. There are different types of games. And you look around at the retirees in Alaska, they're all playing games too. Anyway, so maybe they're still going into banks because they like that and the personal interaction. But I think from our kids and the efficiency, we don't really need that. I will go also, if we're talking about kind of Nigeria, I do think there are places where there's been a lot of volatility in currency prices. There's a lot of cross-border payments. This is why digital money this is why kind of the crypto stablecoins are so important. You save so much money using that as opposed to paying for a service. If there's been I don't remember the numbers off the top of my head, but they've looked into this, right? Cross-border payments and the amount, corporations even. So I'm thinking of Bob and Alice. If Alice lives in Nigeria and Bob's in the United States and wants to send money, there's a huge cost to that. Also, the idea of being able to hold something not in a bank, and I lived in Ukraine before, and I know a lot about the volatility and people's lack of trust with banks, because sometimes the banks would just close, you never get your money back, right? And so that does happen in kind of the idea of we'll call them third world countries, that economies aren't as stable. So I do think the idea of holding Bitcoin or holding some sort of crypto as a store of value makes sense as well. And so I think Nigeria is a little bit different. I'm not as familiar with Nigeria's banking, but I think there's a lot kind of, in Africa, in areas that are less wealthy. Also, not everyone has a bank account, right? If you go to some areas of the world, they don't have bank accounts, and how do they get paid? So then you need cash currency, or you need to have digital. But more people have cell phones now, even if they don't have a bank account. And so I feel like that's kind of where digital will help as well.
And we don't have to go far, right? US, I believe it's 5% of the US are underbanked or unbanked. That's a huge percentage when you really think about the modernization, the open banking policies, the access to so much, the access to many different banking institutions. That's still a huge number. Before we end off, I actually want to talk to you, the concept of hoodies and a suit. I know this is probably not your intention, but it doesn't feel like, women kind of fit in either of those categories. And, as a woman that's received, awards and recognition for being a woman in fintech and crypto, what are your thoughts? Have we gotten better in diversity? Are we still feel like it's a crypto bro culture? We've been to many conferences where scantily dressed women and men, to be quite honest, but are we getting away from this, like, crypto bro culture? And, what can we do to better get to where you think is a ideal place, an ideal where women feel comfortable coming into crypto?
So I think that's a great question. I think that if you look at institutional digital asset groups, there's more women in those than there are kind of in the crypto scene, right? And where we have been hiring, it's hard to find women that are coming in to actually even apply for jobs, I feel like, from that crypto side. So maybe, and more men own crypto than women. I forget, like it's substantially more men than women own crypto. So maybe it's kind of that risk side. There's also less women programmers than there are men, from what I understand. I don't know the exact numbers. So yes, I think, the openness of the culture. There are still, like in finance, when they talk about guys going to strip clubs, I think that still happens in crypto when you hear of some of these parties out there, which is not as welcoming or inviting. But I also think, the people that will do, the companies that I think will do the best are the most diverse companies. And I think of diversity in thought, right? So that I have a different experience than whoever else has that. And then we come to the table and we share our ideas, and it kind of opens up the space. I think the companies that are that way, and the companies to have different ideas, helps that you have different backgrounds, right? And different experiences. And it also helps that that you don't all look the same, right? You don't all have the exact same experience. So I think it does make a lot of sense to have diversity, both from like having more women, but also having, there's not a lot of people of color. There's not as many people of color as well.
Right.
I've found. I could be, at least what I come across. So I do know that one of the organizations is looking to have, like, unmantle the panel to have more men.
I'm a part of that
in.
Association for
Yeah.
Women in Crypto. Shout out
Yeah.
to Amanda Ward.
And so I think things like that are great to highlight it and to show it. I don't think every little bit helps.
Yeah.
Right? I feel like every little bit helps. So
Good
highlighting
luck
women,
executing that token 24. That I think we can breach token 24. That someone internally messaged me. They're like, if it was even more crypto bro than last year. I'm like, is that even possible for token? And I think they still have the best speakers and some of the best in the industry. But when you're not having diverse conversations. Lastly, talk to me about, we have a couple minutes left. Talk to me about the future of Kadena. What are you looking at personally? Like, what's interesting to you? We lightly touched on DeFi, or what's the acronym we should be looking out for? RWAs and real world asset tokenization feels like that was the flavor for 2024. Are there any other acronyms or things that you're excited about?
I love it. Acronyms, right? So I am excited on building. I'm excited on the idea. So the book was a passion project for me. It's not like, I don't think people make huge amounts of money on books unless it's a fiction that everybody, or it's a dating app thing that people read. But the idea of people understanding it, right? And it becoming more mainstream and actually having programmable bonds and having more funds on chain. And that really excites me. So the idea of being able to build, I do also admittedly like, because I'm more TradFi, I love the DeFi side and watching that, and DePIN and all of these different opportunities, because I believe you really are tying kind of a traditional world into a digital world that way, and all of them. So we do have, so Kadena is a non-EVM chain. We have our first bridge coming out next month, which is super exciting. We have a ZK bridge we're doing that's coming out January, I believe. And so just connecting with within the industry, I'm super excited. Some of the projects we're working on, which are really kind of both working with institutions and kind of even levels below, even some fintechs, really just about creating the next generation of finance. So
Right.
I'm a believer in, I don't think about it as just intermediation. I think about it as upgrading, right? And I do think, but that said, I do think similar to kind of Google and Amazon, there will be large companies that come out of Web3 that are seen similar to the banks. I mean, if you think about BlackRock, it's not even that old. I think it began in the 90s. It could be wrong.
Right.
But
They're buying up everything.
yeah,
I feel like it's like, I'm surprised if I'm eating a hamburger and it's not somehow owned as an asset for
the companies, they've invested in the companies that have made that happen.
Yeah.
But if you look at the top data companies in the world, number one is IBM, and then Google and Amazon are in there in the top 10. That's not their main line of business, but they are kind of the Web 2 companies, right? That have recognized business opportunities, and data is just one of the side effects of that. And so I feel like we're going to have that within our space as well. So it's those people that are solving problems that are able to create revenue lines too, because it's not always easy to create a revenue line in a decentralized, open sourced world. But I'm really excited about us growing. I'm excited about having more traditional finance kind of on our chain, as well as building out the DeFi ecosystem, because I think you need both.
I love that. Thank you so much. We are going to encourage people to grab a copy of your book. Although there's none left in Toronto, apparently, because everyone took them all. But we're hoping that we get a shipment soon to Canada. Thank you so much, Annelise, for having this real candid and great conversation. And we're definitely going to encourage people to get a copy of the book, but also look out for you and what you're building at Kadena.
Thanks, Stephen. I really appreciate it. And I love all that you're doing. Love your podcast. Love your questions. So fun to talk to you.
I appreciate it. Researching you was fun. As soon as I saw mortgage-backed security, I'm like, I hope she knows I'm going there. I'm going there.
I love it.
Talk soon.
Take care.